Welcome to the Lead Left Presents, an exclusive series of webinars focused on major market issues impacting private capital. I'm your host and moderator, Randy Schwimmer, the founder and publisher of the Lead Left and also co-head of senior lending at Churchill Asset Management. I want to thank Sherry Chen, my partner in these webinars, for setting up the technology and the work that goes into putting these together. She's our head of digital marketing at Churchill and does a fabulous job. Also want to remind all of you that we do have poll questions, 3 of them, which we'll be asking during the course of the next hour. And you can answer those poll questions by clicking the icon on the upper right of your screens that says, I think, poll questions or polls. And you can answer them at any time, but we'll be announcing those questions as we go forward. Today, we've invited 3 economists, top people in their field, to help us unravel the riddle wrapped in a mystery inside an enigma that is the current state of the U.S. economy. Brian Nick, Chief Investment Strategist for Nuveen, Laura Rahm, Chief U.S. Economist for FS Investments, and Mickey Levy, Chief Economist at Berenberg Capital Markets. These thought leaders have extensive resumes, which you can peruse at your leisure, but their wisdom on these matters will be evident by the hour that we have together. So I want to thank this distinguished panel for joining us. First, Laura, let me start with you. Maybe give us a little background in terms of where we are in the current economy. As I started off saying, it's a very confusing affairs. Maybe you could start by helping to clear up a little bit in terms of where we are, and we can talk about where we're headed a little later.
Sure. I think something that's so important to recognize right now in our economy is that when we think about growth, right, that real GDP measure that most of us are so familiar with, we're seeing something happen that we haven't seen in over 30 years. We're seeing really high nominal growth. That's because we have high inflation. So, we're getting earnings right now, and a lot of earnings still look pretty good because nominal growth really correlates to company revenue and often to profits as well. But what we're experiencing when we think about real GDP is virtually zero real growth. When you adjust that nominal growth for inflation, what's left over is an economy that looks much more sluggish. We're coming off of 2 negative GDP readings in the first and second quarter. In the third quarter, it's likely going to be positive, but that's because our trade deficit narrowed. If we really focus in on that sort of core group of consumer spending, business investment, government spending, that has just looked really lackluster since the second quarter, and it still feels really lackluster today. But we can't just look at growth when we think about the economy. We need to look at jobs as well. And here we're seeing a different picture, right? We're still seeing pretty significant and substantial job growth. And the unemployment rate at 3.5% is really near that 40-year low. So I think something else that's making our economy feel kind of stuck in the mud is the fact that we're adding jobs, but they're not adding output. So really, we're seeing productivity being deeply negative. And remember, productivity is kind of what gives us those cost of living gains, makes us feel like we're getting ahead over time as households, and gives us higher productivity growth. So gives us higher potential growth. So all of that together is creating this idea of an economy that feels really sort of lackluster. And I would reiterate that. My growth outlook is for the economy to remain sort of in this sawtooth up-down pattern. But my growth forecast for 2022 is going to be like 0.5%. It's a very low GDP number.
Thank you. Brian, you comment in some of your work on how this reminds you of 2019, which was not a bad year in terms of some of the data. How do you, what do you look at when you look at what's going on in the economy right now?
Sure. Yeah, I think we all yearn to get back to the economy of 2019, even though it seemed like things were chaotic with Fed rate cuts and the trade war. It kind of pales in comparison to what we've gone through since then. And actually, Jay Powell, the chair of the Fed himself, has talked about wanting to get back to an economy that looks like 2019. I think specifically with regard to the job market, it looks a lot like it did at the end of 2019, early 2020. There's the same number virtually of workers. Labor force participation among prime age workers is basically back to where it was. The unemployment rate at 3.5% is basically back to where it was. And the underemployment rate, which includes people who are working part-time who would like to have full-time jobs, that's also come down significantly and looks like it did at the beginning of 2019. The big difference here is that inflation is much higher, wages are much higher. And the question is, what's different about 2022 as we head into 2023 versus 2019? It's we have the same number of workers, but we have 10 or 12 million more jobs that are available. And that's put some upward pressure on wages. I think we have workers that are misallocated in terms of where their strengths lie. One of the reasons we've had low productivity growth is so many people have switched jobs. You tend to see lower productivity growth later in the cycle as more workers are added, and those marginal workers add less than the ones that came before them. If you have a restaurant, you hire 2 wait staff, they're going to dramatically increase your productivity. If you hire another 10, that 12th waiter or waitress is not going to increase your output by quite as much as the first 2 did. But I think also you have a lot of people who just switched fields in 2020 that weren't able to work in service jobs, switched to goods jobs, and those jobs are becoming less necessary as US and global consumers reorient their spending behavior towards something that looks, again, more like 2019, less in terms of goods purchases, more in terms of services purchases. And so we don't have enough people working in service industries, for airlines and hotels. We probably have too many people working in goods-based industries, and that's not moving quickly enough based on how consumer spending has shifted. And that's creating a lot of the handoff in inflation that we've seen from goods to services. Even though demand is not as strong as it was last year, we still have inadequate supply in a number of these areas. And I think that's continuing to keep inflation higher than it would be otherwise, and certainly higher than it was at the beginning of 2020.
So, Mickey, one of the things that seems to be coming out is that there's so much data, which often is conflicting the labor data that Brian and Laura have addressed. What do you look at when you look at what's going on right now in the economy? What kind of data speaks to you that is as clean a representation of where we are as it can be?
Well, Randy, the broadest measure of economic activity or current dollar spending is nominal GDP. And here I'd like to go back a step. And you asked, how did we get to where we are? Well, we had a negative, the pandemic represented a negative shock to supply and demand. And then we had excessive fiscal and monetary stimulus that generated the excess demand relative to productive capacity. And so what comes out of that is inflation, and the inflation is constraining real purchasing power, and now you have the Fed hiking rates. And I agree with Brian that there, when we think about these shocks, the impact on different types of constraints and shifts in labor supply are really quite interesting. So as for the data, I'll look at nominal GDP, which is still rising rapidly, or even you can look at nominal consumption, and you could basically say, hey, we're still at the early stages of the disinflationary process. That's just obvious. Within that, I will also look at some of the details of employment. And once again, labor markets are very complex, and job openings may disappear very, very quickly because the cost of posting a job opening is far, far lower than in the past. So I'd look, so to summarize my views, look at nominal GDP. I'd look at a lot of the details of labor markets, including, claims, the ADP wage tracker and the like. And then in addition, I encourage you to look closely at different measures of inflationary expectations, OIS, swap spreads. And the reason why you want to look at those is the Fed's looking at those.
So that's an interesting question, and maybe Brian, you can talk about what some of the other things the Fed is looking at, because obviously There's a lot of data. And while we're doing that, we're going to, Sherry's going to post our next poll question. So if you want to go to that link again, the question is going to be, where's inflation a year from now? So we're going to ask that. So if you want to start weighing in, and we can see what our economists think. But what do you think the Fed is really focused on that's going to continue to trigger Fed rate hikes?
Well, I think we have to take the Fed at their word that they're focused on the labor market. This has been the thing that Jay Powell, in virtually every press conference he gives, has been hammering home. There are too many job openings for a given set of unemployed workers. Right now, we have about 10 million or so job openings. We only have about 6 million, a little bit below 6 million unemployed workers. And that 4 million worker gap, the theory is that will start to put upward pressure on wages if it hasn't already, because you simply have too many openings and too many employers looking for people, and there just aren't enough of them, and they may not be in the right industries or in the right areas of the country, which means that the pressure potentially is even greater. I think, interestingly, last week, Lael Brainerd, who's the vice chair now of the Fed, came out and talked about profit margins as something that she's watching. A lot of inflation accrues not just to workers, but also to company profits, and even that we're seeing through the third quarter reporting season in the United States, have stayed pretty healthy. Profit margins are still pretty wide. And one of the things she's looking for is evidence that Fed policy is denting demand or damaging demand enough to bring down revenue growth and to sort of squeeze those profit margins, especially in areas of the economy where we know consumers are sort of turned away, right? Look at where people are not buying things this year. They're not buying large appliances, outdoor grills, all the things that people bought a lot of in 2021 that tend to be durable. We call them durable goods. And hopefully, if you bought a TV last year or a washing machine last year, you're not buying one this year. So we're seeing evidence of growing inventories and declining revenues, and eventually also declining profits for the types of companies that make and sell these things. And I think it's another area where the Fed wants to squeeze the economy a bit more as evidence that it's slowing things down. But obviously, the Fed doesn't want to go too far. It doesn't want to see rising unemployment, but this is a carefully calibrated policy using a relatively blunt instrument. It's hard to imagine they're going to be able to thread the needle and accomplish precisely what they want, which is a decline in job openings, a decline in wage growth, without also resulting in higher unemployment.
And we're going to get to that question in a second, Laura. As we ask our viewers to look at the poll question and answer, where is inflation going to be a year from now? Maybe, and I know that's probably like a CPI question if you want to answer that, and CPI has its pluses and minuses, but where do you think, as an informed observer of these things, where do you think it's going to be a year from now? And we'll see what the rest of the audience thinks.
I think that inflation is going to be persistently higher than it's been for the prior sort of 25 years before the pandemic. So my forecast for the sort of a year from now is headline inflation at 3% and core inflation at 3%. And I think that really we don't get a significant relief on that until really the middle of next year. So I think the next 2 quarters, we get inflation staying quite high. Inflation's got a lot of momentum. The CPI index, as you pointed out, and this is, just sort of an observation about the nature of its construction, is heavily weighted towards rent. And rents have really been extremely persistently rising. And I think that's going to continue for at least the next 2 quarters. There's actually a 12-month lag between the high frequency data and when we actually see the data hit the CPI. So that still is working its way through into the broad headline measures. And then, I think that the Fed is really using a lot of the same labor models that it's been using for years, that it calibrated during the 90s and 2000s. And the reality is we just have a very different labor market today. We have a lower participation rate because we lost a lot of baby boomers during the pandemic. They're not coming back. And the reality is our labor force growth is very slow right now. So I think the Fed is trying to, really focus us on the labor market. And I think the problem with that is that they don't appreciate that the labor market has changed a lot. It's going to take more to impact it, I think, than it did in prior business cycles, simply because of, I think businesses will be a little bit more protective of holding on to workers at this period. And I think at the end of the day, all of that is going to lead to some persistently higher wage inflation.
Okay, well, let's see what the audience thinks, Sherry. We completed our polling, and let us see if we can take a look. So there's the question. So if a year from now it's less than 4%, between 4 and 6%, 6 to 8, greater than 8, and I think so. Laura, you're kind of in that 3 plus 3, so you're in the 6% if you include everything, correct? And then
That's
you've got yeah.
I would put myself in the less than 4, but
Well,
not back at 4%.
Okay.
Yeah.
All right. So we'll come back to Sherry on that. I guess maybe Brian and then Mickey on the issue that Laura raised, which is growth. And we had a negative first quarter, negative second quarter, and here's the answers. Okay. So, all right. So it's a pretty interestingly. So, the difference, there's only about a third of the audience that thinks that inflation will either be greater than 8% or less than 4. So most are kind of in that 4 to 8% range split. So it's pretty wide range. Let me turn Brian to you in terms of just the third and fourth quarter. Do you agree with Laura that it's looks like it's kind of sloppy sideways, that we're going to have kind of anemic growth if growth we're going to get? And are we in a recession, if that question matters anymore?
Yeah, so I think the academic response to are we in a recession, I think is still no. There's a group that decides these things, the NBER. The first half of the year, I think colloquially will be defined as a recession unless we get revisions that show the growth was positive. But I think I agree with Laura that the number we get next week for the third quarter is going to be, I think, pretty strongly positive, but affected by a lot of the same kind of weird idiosyncratic factors that plagued the first two quarters, namely big swings in inventory, big swings in net exports that don't really go to the core of the U.S. economy and specifically what's driving demand. So the subset of indicators that I look at within the GDP report, it's called final sales to domestic private purchasers. I know that's a mouthful, but it basically is just isolating consumer spending and private investment, taking out the government, taking out net exports, taking out inventories. Basically, just what did businesses and consumers buy that was made in the United States in the third quarter? And that number, I think, is going to be similarly sort of like ho-hum weak, similar to the first two quarters of the year, probably somewhere between 0% and 1% on an annualized basis, which is not a fantastic rate of growth. Last year, that number was really, really strong as the economy reopened and people spent their stimulus checks down and businesses did a lot of investing and hiring. I think this year it's going to show signs of slowing. And I think that the risk is clearly that in the fourth quarter of this year, the first and second quarter of next year is where we sort of have the economic bottoming in terms of demand, where interest rates take more of a toll on economic growth. You clearly are going to see a huge negative number for residential construction as activity related to the housing market continues to decline because of higher interest rates. And eventually, the theory goes, at least, is that the rise in interest rates that we see to 4.5%, maybe 5% is going to have a slowing effect on the economy. So the real risk of a recession, I think, in the conventional sense of one where we get higher unemployment and negative GDP growth, is going to be in the first half of next year.
Okay, that's specific and helpful. Mickey, your commentary has been, pretty hard on the Fed, in terms of, getting started late in the game, because you had been telling them get going, and they really took their time, and now they may be playing catch up. Are you pessimistic about a recession in the sense of hard landing versus a soft? What's your view, since it feels like the Fed is really racing and playing catch up here?
Randy, I think there will be a recession, but it'll be of a mild sort. But I'd like to get back and pick up on two really great points that Laura and Brian made. One is on just inflation and how it lags. And late last year, I estimated a model, a vector autoregression analysis of OER and rents, and said which is the shelter is the largest component of inflation, and I estimated this model, simulated it, and as Laura said, there's about a 12-month lag. We found the optimal lag to be a little longer than that, and I forecast that OER and rental costs were going to go through the roof, and that is what has happened, and what's going to happen here is, even as housing activity is falling and case-shiller home prices are going to fall or roll over, you're going to continue to have upward pressure on OER, rental costs, and shelter costs in both the CPI and the PPI. In addition, a point I would make is, yes, we should see some lower inflation in goods, but services, which are the bulk of the economy, they're very labor intensive, and we should see continued pressure on wages. So as service providers experience higher operating costs, with nominal spending, particularly the rotation from goods into services, you're going to have continued inflation there in areas like medical costs and other areas. So inflation is going to continue with a lag. Another point I'd like to bring out to emphasize what Laura said is the Fed is using old-fashioned labor market models, and I'll just underline that point. In fact, what's been so stunning about this whole experience is, if the Fed would have just relied on any standard model, they would have forecast sharp increases in inflation, whether it's a Keynesian model or a monetarist model or whatever. And now they're still, when they look at labor markets, they are thinking in a very old-fashioned way. And even if you read the Fed's leading research on labor markets, it tends to be behind. And if you were to ask Jay Powell, other members behind closed doors, how do you forecast inflation? Basically, they're winging it. And over the last year, you could just see, because they perceived inflation was going to come down and it didn't, they just had it revert to their desired level. So I think we've got a ways to go. And then Brian brought out this great point on margins. And I just want to make the following point. When the Fed says we need to raise rates in order to lower inflation, if you think about the disinflationary process, it's all about raising rates enough to slow nominal spending growth, that is business top line revenue growth, enough to reduce their flexibility in raising prices, which involves not only slower top line revenue growth, but a squeeze on margins. And we're just beginning to see that, and the process is still unfolding. And I'll just conclude on one point. I've gone back. I wrote a study on the history of monetary policy since the Fed was founded, and 100% of the time when the Fed was easy, then had to raise rates to slow down inflation pressures. 100% of the time they had to raise rates above inflation, and we're not.
That's interesting. So, Laura, let's pick up on Mickey's theme about where we're headed with the Fed funds rate, and I think Sherry's going to get our second poll question up and running, which is going to be for the audience to take a guess at where they think it's going to peak out. But to Mickey's point, some of the things that the economy is driven by will be impacted by a Fed rate hike, but some won't be. Maybe you can kind of enlighten us as to which is which.
Yeah. And, not to make us sound like an echo chamber, but Mickey brings up this really important point, which is that, we haven't yet reached peak Fed hawkishness. And by that, what I mean is, sort of the market expectation of the Fed's sort of finish line during this rate hike cycle keeps getting pushed higher and higher and higher. And, just even 3 months ago, that number was 4. And before the last CPI number, we were at 4.5 or, a little bit above 4.5. And now we're close to 5. And the reality is the Fed is just so far behind the curve on inflation during this cycle that a lot of folks are pointing to, core CPI is at 6.6, and the Fed has never really been able to tamp down this fire of inflation without raising the Fed funds rate above that. So I think this question of the end point, sort of the finish line of this Fed rate hike cycle, it keeps moving. I think we're going to continue to see it move throughout the fourth quarter. It is really severe uncertainty that is deeply impacting markets as we see. And, I think at the end of the day, the call from a lot of sort of, folks like me, a lot of pundits are going to continue to get louder to try to sort of take a pause, to ratchet down the pace of rate hikes, to let the rate hikes that we've already seen have an impact on the economy, because there's also a lag with how rate hikes impact the economy. That process is much faster with financial markets, but it takes longer to hit sort of the real consumption, the real growth, you know, with the exception of housing, which has already clearly been deeply impacted. So we're going to continue to see that throughout the next year. And this is where we have such a tough communication stumble with the Fed, because markets have gotten so used to, over the last 15 years, really since the mid 90s, the Fed cutting rates quickly at signs of trouble or signs of financial stress. And so we've seen again and again throughout the last year, the market has this sort of dalliance with this idea that the Fed is going to raise rates and quickly cut them again, kind of like we did in 2019. And the Fed has had to push really hard against this idea. So it's not just the endpoint we have to think about, it's what happens after that. And that there probably won't be a fast inflection of rates falling after they sort of hold us at some level.
So it's not going to be an inverted V. We're not going to see it coming straight down. Sherry, why don't we show that poll question? Where does the audience think the Fed funds rate will peak? And it looks like, so 4.5 to 5, so pretty close, Laura, to, the terminal rate that seems to be in the numbers, because they've raised 300 basis points. They probably have another $1.25 for this year, probably some more. But it's also, there's a considerable part of the audience that thinks that it's going to be even higher. So almost a third is higher than 5.5%. So, Brian, Nick, what do you think? You think that's where do you fall in that? In those guesses?
So I wouldn't be in the 6% or higher category, but I'm a little surprised that more people aren't in that, because where that sort of modal response was in the 4.5 to 5%, that's where the market is right now. So at any given time, if you were sort of marking your expectations to market, you've been wrong all year, as Laura said. Coming into the year, remarkably, the consensus expectation for how much the Fed would have to hike this year was around 75 basis points, maybe a little less. Now that's like a normal meeting where they just hike 75 basis points, and there's 8 meetings per year. So we've had this shift so far so quickly. It's no wonder the markets have behaved the way they have. Every single box that you check for tighter financial conditions affecting markets has happened this year. Stronger dollar, poor equity market performance, wider credit spreads. We can go through the list. The ongoing risk that investors have if they're looking for a foothold or even a toehold is, as the Fed gets more hawkish, as we find ourselves still that same distance away from peak hawkishness, even as we move forward in time, it gets a little bit further away, is enormously disruptive for markets because of the higher discount rate, because of the risk that as the Fed goes to 5.5, 6, if that's really where they end up, that's going to have a much more severe impact and make it almost impossible to settle on this, soft landing, immaculate disinflation scenario that a lot of us were hoping for, and I think still hoping against hope that we will, eventually come down on. I would say that my expectations are that we aren't going to see enough evidence of disinflation between now and the end of the year for the Fed to make a meaningful pivot towards hiking by less, let alone pausing or cutting rates. And so I think the risk that's starting to get priced in for December, November is a done deal. They're going to hike 75 basis points. The risk for December now looks more like 75, because what's the excuse to stop if you continue to see higher than expected inflation and less disinflationary force, especially in the services sector of the economy?
So, Brian, let's stay with you and talk about a topic which all three of you have raised, which is the labor market. Break down for us exactly what's going on with employment, which you made the point earlier that it's a critical part of the equation, not necessarily unemployment, which is at 3.5%, which is close to an all-time low, but also what's going on with employment. We talked about hiring and openings, and also just wages. It feels like even in this, where the Fed would love to not see wage prices increase, or because that's adding to the problem. Could you paint a clearer picture for us as to where we are?
Sure. And Mickey was entirely right that the larger portion of the US economy, which is services, is very wage sensitive. So it's almost impossible to get meaningful disinflation in the services area of the economy. Think about getting your hair cut, getting your nails done. As long as wages are moving up, it's going to be very hard to see any kind of slowdown in inflation in those areas. So this is why the Fed is focused like a laser on the labor market. I think what we are seeing, though, is hiring that's still very strong compared to any pre-pandemic standard. If we're adding 2, 3, 400,000 jobs a month, that dwarfs any average that we could have expected to see in really any of the 2010s. Even in the early months just after the financial crisis, the recovery was quite slow. That was not the case in the COVID crisis and recession, because it was a very, very different set of circumstances. We are continuing to find more workers to put to work, but we're not bringing them off the sideline, so to speak. We're just bringing them in for the ranks of the unemployed, which is why the unemployed rate is so low right now. We're running out of quote unquote extra workers. We are seeing some people unretire, so that 55 to 64 cohort is not participating to the same degree it was pre-COVID. I think that's understandable. Financially, a lot of those people probably found themselves, at least up until the last several months, better off than they expected. Maybe they retired early. Ongoing COVID concerns obviously are another factor keeping older workers out of the labor market. But to your point, demographically, we're just seeing an aging of the population. That means we have a lower overall supply of workers as a percentage of the overall size of the population. And we've been getting fewer and fewer immigrants to come in on work visas to be able to fill those jobs as well. So we have the same number of workers that we did at the beginning of 2020, but we have at least 10 million more jobs to fill. And unless we get that resolved, either with fewer jobs posted, or we somehow find miraculously more workers to put to work, which I think is less likely in the near term, we're going to continue to see this tight labor market. So I will just echo the point Lara made earlier. It may be that 2020 condition, that early 2020, where we had very low inflation and very low unemployment, is just not something that we're going to see. Maybe that was the anomaly. And what we're going to see going forward is higher structural wage growth and lower overall unemployment. So I'm optimistic that the unemployment rate isn't going to move up that much, because there's this structural demand for workers that just isn't going away.
Yeah.
So, Laura, let me ask you and then Mickey the poll question, which is our last poll question, which is to predict where U.S. unemployment will be a year from now. Where do you think it will peak? Or it's at 3.5%. So we suspect that it's going to be going up. Is it still going to be less than 4%? Between 4 and 6, 6 to 8, greater than 8%, which would be quite a move in a year. Laura, and then Mickey.
Man, you don't want Mickey to go first on this one? I think this is, to me, one of the trickiest questions that we're dealing with right now. And let me just say that I think, every business cycle throws something new at us, and we learn and we evolve. And I think something that was really striking about the pandemic was the fact that companies laid off so many people and have really had trouble getting those folks back in the seat, for so many reasons that came up during COVID. So what we've seen over the past year, for example, or when we had, the Delta wave in September of last year, which arguably, caused disruption in foot traffic at stores and disruption at restaurants. We had the same thing with Omicron over the holiday season. We did not see initial claims rise during those episodes. And that is, what happens when companies lay people off. Ironically, the hurricane that we just saw was a much more typical response in an economic disruption. We do see those layoffs pop higher and then they come back down again. To me, it's really a sign that businesses are trying to retain workers. It's even something the Fed's own sort of anecdotal regional regional board discussions have shown in discussions with larger companies that, they're thinking about worker retention and they don't want to overfire again. So this is a place where we may see companies take longer to fire people. I don't know how much that dynamic is going to cause the unemployment rate to move up slowly. And here's where I leave it to Mickey to give us the wisdom of history, because I know that when you look back, one thing the Fed is bad at doing is getting the unemployment rate to go up just a little bit. We're 3.5 now. I think a recession, we get to 6%. Which is a lot less than the prior two recessions, that's for sure, but it's still not great. Mickey?
Okay, Mickey, solve this.
Laura, you bring out a really interesting framework that when we think about it, once again, when we think about the disinflationary process, the Fed hikes rates, it hikes rates enough to slow aggregate demand in the economy. And then the critical question, and it's a behavioral one, how do businesses respond? And that's yet to play out. But based on history, okay, so here's where it gets interesting. The last two recessions we had, 2020 and the great financial crisis, 2008-9, we had deep recessions, sharp declines in real GDP, and unemployment rates went up sharply. The two prior recessions, 1990-91 and then 2001, real GDP barely declined. But in both of those, even though they were very mild recessions, the unemployment rate in both went up by several percentage points, and initial unemployment claims, that is job layoffs, increased by several 100,000. And so if we're thinking of even a mild recession because the economy is in much better shape now, business and household balance sheets, the fact that labor supply shortages left us with insufficient labor rather than excess labor, et cetera, et cetera. Even if we have a mild type recession, I think we're looking for the unemployment rate to go, maybe to 5.5%. So let me add a touch of color here, and that is in May. There was a major monetary policy conference out of Stanford, and I gave a paper there. And then in the final panel of the day, two leading Fed members spoke. And this was 2 days after the Fed had raised rates 50 basis points. And at the end, each of them were given 15 minutes. It was Jim Bullard and Chris Waller. And each were given 15 minutes. And then I asked the first question from the audience, and it was, do you guys think the Fed would be willing to tolerate the unemployment rate going to 5.5% in order to get inflation down to 2%? And you kind of had to be there because they both looked at each other, laughed into the microphones, and said, Mickey, we can't answer that question. And I think if you were to ask that question to them today, they still couldn't answer it.
Yeah.
So we're going to see this play out, in I think, in the next 6 months.
Yeah, absolutely. Well, let's take a look at our audience and see again what the answers are. Okay, there you go. So the 5.5 is in that range. So 46%.
Randy, you're already hearing some Fed members like Vice Chair Brainerd and Charlie Evans, who are already saying, watch out for the lags, and we're going to have to take a more balanced approach. So while the Fed's talking a tough game now, there's a lot that can happen that could lead them to change their objectives.
Yes, you could definitely hear the Minority Report in the background, just raising their voice, which I think is actually a good sign. Let's, in the 20 minutes or so that we have left, let's expand our view a little bit of the economy and look globally. And Mickey, maybe stay with you because you've written a lot on China, and then I want to turn to Laura and Brian on their thoughts. But what are the other central banks? Because they're if you look at Europe, for example, the ECB, it's a very different situation, right? What they're dealing with is and wrestling with is different than what we are. But how, if you could compare the other central bank policies with what the Fed's doing, that would be helpful, I think, for our listeners.
Sure. Well, the Fed is way ahead. The Bank of Japan still has negative rates and massive asset purchases. The ECB, how do we describe it? The ECB is dithering, and as its core inflation is increasing a lot and has deeply negative real rates, and its goal is just to keep the peripheral spreads narrow, and it's going to move ever so slowly. The Bank of England is an embarrassment what they're doing now, and of course this is adding to the strength in the dollar. So expect the Fed in at least through first quarter, expect the Fed to lead on the majors, but not the Bank of Canada. Now, regarding China, I think it's critically important. In the last 25 years, China's been the engine of global growth and trade. Its economic weakness is severe, it's persistent, it's not going away, and China's no longer the engine of global growth. Its problems are deep-seated. Their real estate problems are simply symptoms of the way the government's overinvested in real estate. 80% of household net worth in China is tied up in real estate, which is falling sharply, which is affecting consumers' propensity to spend. That is the negative wealth effect. And at the same time, now China's facing declining export orders. But in the longer run, don't look for China to bounce back. I mean, they could print a number of 4% if they want, but China is no longer the leader of global growth, and it's having a significant impact on emerging nations and some leading industrialized nations that are major trading partners of China. And I can't emphasize this weakness in China enough.
So we're actually looking pretty good relative to certainly, as you mentioned, ECB and Bank of England. Laura, anything, Laura, on that? Any follow up on the other central bank policies?
I think Mickey brings up an important point, and I think he did a great job of giving us a 360 of where the other central banks are at. Japan also maintains a very easy policy in juxtaposition with the aggressive Fed tightening that we're seeing. But I think there's a bigger issue here, which is that we've had 25 years of this march of and this rise of globalization. And it really gave the US economy a canopy of durable goods price deflation through cheap imports for durable goods, cheaper imports. And, we've talked a lot about the Fed today, and I think we need to ask ourselves, looking back over that 25 years, we had the rise in globalization. I think, Mickey highlighted the fact that we had 2 recessions where GDP didn't fall a lot, but we saw a lot of layoffs. That's related. And we've had 25 years of this very low inflation and low volatility of inflation. I think we need to kind of remind ourselves, was this the Fed that really had a perfect finger on the pulse of how to titrate monetary policy to keep inflation low? Or did we just get a lot of help through this expanding globalization process? I think one of the reasons why I have a 3% inflation forecast is because when you take the resting heartbeat of the US economy, it's probably higher than 2%. And I think, to me, the globalization piece is really important because now we're seeing a lot of that unwind, and it's unwinding fast. And I think we're just beginning to wrap our head around the implications. And one of them may be more volatile economic cycles, more volatile markets, higher inflation, all else equal. And potentially all of that creates more volatile monetary policy responses in the short term.
Interesting. And Brian, you've written as recently, I think, as last week, on sort of the relative strength of the global economies, U.S., Europe, and China, developing nations. And I think, based on some of the charts, it looks like next year does feel like, at least the IMF is predicting, that China and emerging markets will do better than US and Euro area.
Yeah, well, China is going to have the advantage next year, hopefully, of being fully open for the entire year. So I don't know, people may have been following this, that China was supposed to release its third quarter GDP number and a couple of other data points, and they haven't done so yet. Haven't said why or when the number's going to be out. So now we're turning to things like satellite data, where we're looking overhead at how many cars are in parking lots of retail stores, how many trucks are leaving cement plants, how many new cars, used cars are sitting on lots, how many people are buying and selling cars. So we're kind of going down to that, I guess you would say, newfound data sources with the official data not really being published. I think it's a sign that even Chinese authorities are going to have to eventually admit to just how weak the economy is at the moment. And if you turn a light switch off and they turn it back on, it's going to be brighter, in 2023, assuming they don't go through another round of kind of COVID-related shutdowns. But China's also going to be selling into a world that isn't going to be buying as much stuff next year, because we do think that developed markets, including the United States, are going to be slower in 2023. So all is not well. I think I agree with Mickey's assessment of just how poorly things have been run in China and what their economic outlook really is. But if you look at the direction of monetary policy, a lot of these central banks, including ones you wouldn't expect, like the central bank in Brazil, did a really good job of getting out ahead of inflation. Brazil hiked rates by over 1,000 basis points. Their markets have rewarded them for doing that. They've also been advantaged by the fact that energy prices have moved up, and they're a big exporter of energy, including to China. And I think next year, with developed markets slowing under the weight of higher rates, emerging markets may have, economically speaking at least, a chance to get out from under it. But again, they're still very contagious to slower developed market growth. So I would say that, we're not expecting a bonanza really anywhere in the world for economic activity in 2023.
So, Brian, let me stick with you, and then I want to go to Laura and Mickey on this last question, then we'll turn it to the audience. The US dollar, I think a discussion of the economy would not be complete without a discussion of the US dollar strength, how it's affecting, the Fed's battle against inflation, what's it doing to exports, and so forth. Maybe chat a little about that, and we'll swing around to the other panelists for their views as well.
Sure. So a stronger US dollar sounds like a really good thing in a vacuum, but it tends to be, when it happens really quickly and severely as it strengthened this year, it tends to be destabilizing for the global financial system. We're seeing signs of this certainly in the UK over the last couple of weeks, because the US is still the desired destination for global investments. because we have the highest real interest rates of any developed market economy. So while you look at the 10-year in the UK and the 10-year in the US, they're about the same. They're both around 4%. But underlying that 10-year is much higher inflation expectations in the UK, lower inflation expectations in the US. So our real interest rates are higher, which will tend to, over short periods, determine how exchange rates move. And frankly, as Mickey said, the Fed's been way ahead of the game compared to most other developed central banks, which means we have higher real interest rates and are a more attractive destination for people looking to make investments. We also are doing better economically at the moment. So we have companies that look like more desirable investment destinations. And when you're concerned globally about a slowdown and there's a bit of a risk-off tinge to how investors are looking at the world, the safest destination of the world still looks like the US. So again, check all those boxes for why the dollar would appreciate. You basically check them all off in 2022. What you end up with, though, is situations like we have in the UK and elsewhere, where you have rising interest rates in these countries that are not, banana republic basket cases. The UK is, one of the strongest, largest economies, most creditworthy economies in the world. But you have rising interest rates and a falling currency, and that is not a good mix for financial markets, for the economy. And then you had a new government that exacerbated the problem by announcing rapid fiscal expansion. And for the first time in many, many years, you had a genuine old school bond market revolt that forced them to reverse course. And so if you see more of that kind of thing, part of what's driving that is the fact that the dollar has gotten so much stronger, even against other strong, credit-worthy, stable currencies like the euro, like the Japanese yen, and like the British pound.
And Laura, it doesn't feel like that's going to change anytime soon. Certainly, the Fed is not going to interfere with it. From what we can tell, they're going to let that ride. What's your view of where the dollar is and where it's headed?
Yeah, I continue to think that the dollar is going to stay strong and could even strengthen from here, at least for some time. I think, it's important to remember, on top of everything that Brian said too, that, at the margin, the strong dollar is sort of right now pushing in the same direction as the Fed policy, which is trying to slow our economy down. It's going to make things, much more difficult for exporters. And you've seen companies that are heavily reliant on foreign revenue generation have really underperformed companies that are more reliant on domestic revenue generation. But the strong dollar really complicates things for other central banks. Oil is priced in dollars. So the price of oil has risen 11% in, if you're buying it in America in dollar terms, but if you're buying it, in Japan, it's up 40% year to date. It's up, over 20%, 25% in Europe and the UK. So they already have inflationary problems, and their weak currencies really exacerbate that. So it does make things quite complicated. And I think, one thing Brian touched on, the speed of the move is part of the challenge. Companies, work to hedge around this, but they don't often hedge out past a year, and they often miss the hedging when the move is this extreme. So I think it caught everyone really off guard, including policymakers. And it's just really creating this echo chamber of volatility that we're seeing in other markets.
Interesting. Mickey, what are your thoughts on the dollar?
So look, the dollar's strong, and it's strong, but if you remember, a currency is a relative price. And if you look at the dollar strength, every other country or region where the currency is weak has its own story. China, the yuan has crumbled. It's crumbled because it's a policy variable, and the Chinese leaders know they desperately need to prop up exports as domestic demand is so weak. Europe, the euro is weak because the risk-adjusted expected rate of return on euro-denominated assets is very, very low, and their potential growth is low. The UK, there I take a little issue with Brian's, who I think, Brian, I think you said that it's the weakness in the pound that generated the problem. I think there, 10-year gilts, yields soared, but they did in the U.S. also. It was just we didn't have a financial crisis in the U.S. We had an adjustment of financial asset prices. The financial crisis in Europe, excuse me, in the UK was all about the failure to hedge against volatility by pensions, and then the absolutely horrible policies of the BOE. So the point is, each currency, cross currency, has its own story. And I would note that, prior to the Russian invasion of Ukraine, the dollar was actually drifting down a touch, even as the Fed was rotating toward tightening. And so it's a very volatile area. But when I think about the biggest consequences of this, I look to certain emerging economies. And as Brian pointed out, you have some Brazil moves and has positive real rates there, and its currency is doing okay. But then you look at places like Turkey, where the central bank is lowering rates while inflation's going toward 80%. And you have a large amount of Turkish corporate debt that is denominated in dollars. And so this gets to Laura's point, in your own local currency, costs could be going up a lot. And it's an adjustment. And I think it could add to volatility. But my bottom line is, yeah, the dollar's strong. Don't blame it on the U.S. You can blame it on the Fed for not having moved last year. If it had moved more gradually, you might not have had these immediate problems. But I think a lot of other nations whose currencies are quite weak, could put in place some policies that would help them, but they're not.
Yeah, interesting. Okay, so the last question comes from the audience, and then we'll wrap up. So, and I'll ask Brian and Laura to weigh in on this, and it's regarding kind of alternatives in an environment where obviously the public credit and public equities markets have endured a lot of volatility, and you both write extensively on the use of alternatives. In your research and writing, maybe you could just spend like a minute talking about, what are the portfolio implications? Where do alternatives, as an example, fit in, given everything we've been saying for the last 58 minutes?
Sure. I'd say that the most obvious thing you can say about most alternatives, doesn't go for all of them, it's a pretty eclectic mix of asset classes, is that for 2022, that immediate price discovery, that daily mark-to-market, daily liquidity has not been your friend. If you're looking at the credit markets, the rate markets, or the equity markets, you've seen continued volatility really starting at the beginning of the year and not letting up throughout the year. So if you own a significant allocation to alternatives, even if there are alternatives that I think in the underlying intrinsic value could be correlated with these other markets. The private equity is going to be ultimately correlated to some extent to equity markets, private credit to credit markets. You haven't had the daily, weekly, monthly market gyrations affecting the underlying value to the same extent, at least not in a way that's visible. I think that tends to be good for sort of financial hygiene for investors who are doing the right things in their portfolios, to have some of that sort of lack of immediate liquidity to access. I also say the other thing is this is creating a lot of opportunities, and most alternatives, the vast majority, are going to be heavily actively managed. And we are in-house at Nuveen identifying more and more of these opportunities in public and private markets coming out of this drop in valuation that we've seen, and anticipation of further economic weakness that's making investors a bit skittish. This tends to be the time when it makes sense to deploy these longer term investments, maybe even tranches of investments, into areas like private real estate, private credit, private equity, in a way that maybe didn't look as attractive to start the year because we came into the year with very high valuation. So I think there's a number of different rationales for why you'd own alternatives: more inflation protection, diversification by liquidity, diversification by asset class. But I think all of them continue to make sense, even in an environment where public markets have performed, tended to perform so poorly in 2022.
Laura, you have the last word.
I think one thing that we just have found out in 2022 is what the impact that we get when all of these correlations just rise so significantly. This happens, it turns in the business cycle. And I really do think that looking ahead, we're in a world where we're going to see the business cycle be more volatile. I think we need to appreciate the fact that inflation did truly skip a generation. And I don't think that inflation goes back into the 2% package that it had maintained for 25 years. So we need to really be ripping apart our portfolios and rebuilding them with investments that can manage through higher inflationary environments. It's more floating rate products, it's more active management, it's more real asset investment focus, more real estate focus. And I think these are the things that we need to just really reconceptualize, because our old notion of diversification, sort of tinkering within the S&P 500, has just been blown apart by the fact that in this higher volatility environment, we're going to see this higher correlation, and we need to find sort of truly undiversified assets and give them more weight.
Laura, FS Investments, we look forward to having you back. Thank you very much. Anyone who wants to get more insights from Laura, just check out the fsinvestments.com website. Is replete with some great research. Brian Nick from Nuveen, if you want to get his, you can. He's like Laura, is on a lot of media, but you can get his research at brian.nick@tiaa.org. Mickey Levy also publishes some extraordinary work. You can connect with him at mickey.levy@berenberg-us.com. I recommend all three of these great thought leaders to you, and I appreciate your time very much. Join us in January. We're going to be reprising this past January's discussion of middle market M&A. What is going on in the deal market, given everything we have heard about the economy? How is this all affecting deal doing in the middle market in the U.S.? So with that, thank you, everybody, and have a great day.